Good afternoon, ladies and gentlemen. We start this week's review by looking at the most important yield there is out there, the 30-year. And this week it's done exactly what we thought it would do. It has come back and touched the 50-day moving average and the center of the Bollinger Bands. It's nicely consolidated off this 320 to 322 area, which is so pivotal. Any break and close above 322, call it two breaks above and two closes above, will really spell doom for the equity markets. I certainly am in the camp that says the equity markets cannot withstand new highs and a trend higher in 30-year yields. Completely agree with Gundlach on that one. But fortunately, I don't think it's going to happen. It's much more likely to come and test these levels around 305 and just whipsaw around for several weeks in a 305 to 315 area. So while the market is this stable, while there is no reason to suppose or presuppose that the Fed is going to be more aggressive than it has said it will be, there is absolutely no reason to assume that the yield in the 30-year is going to go much higher. In fact, the yield in the 10s probably has a little bit more room to the downside to around 287 to 88 before it resumes trading in a sideways pattern. Certainly this MACD for the futures looks like the market could push up towards 120.07, 120.05. Steady as she goes in the 10-year, and the same thing can be said for the 5-year, which is here. It might come all the way back down towards 268, 269. It certainly does not look like a market which is in a trend and it's ready to break higher at any moment. Certainly breaks above this immediate high at 285 will be very, very bearish for all assets, including equities, but we just don't think the market has the reason or the stamina to go for these new highs just yet. And that is because the dollar has done quite a bit of tightening for the Fed already. The dollar is now down more than 3 percentage points from where it has been trading for the best part of last quarter. It is now actually, this is the start of the year, it is now basically below the level where it started the year. Everyone is happy, the dollar is steady, the Fed has its tightening, and the ECB can start being more aggressive if it feels like doing it. It is below the 200-day moving average. It should now trade in a 118-ish to 121.5, something like that, 121.40 range for the next few days. And then probably do another C leg down towards 116 before he goes back up. This actually very much tallies with what we've been saying in the DX, which is basically look for a move back up to 93.94. We are nearly there, and then sideways price action for quite some time before in late summer we start swooning again to the downside. That is our view. We've been quite correct in it. We thought the dollar would go down, then we thought it'd done enough. Now we think that it's probably going to do enough on the upside. Certainly this level around 94 is going to be extremely, extremely tough to break. Be anywhere between 94.23 and 93.63. That's a 0.5% range, and we don't think it's going to be very easy for the dollar to break those levels before it's consolidated. This is a chart of the stocks, and you can see how it is now way above the level where it was when the ES was trading 2800. This level here is where ES was when it was trading when ES was trading 2800, stocks was here, and now it's significantly higher. This is just the effect of the dollar and people moving out of US equities into cheaper European ones. We now probably have moved to certainly have room to run towards 36.10 to 36.20, but that is probably as far as it goes, because we really don't think that the dollar is going to be that much more of a wind at the back of European equities. We are a much better buyer of US equities now, and especially the Nasdaq, which where the technology sector has resumed its leadership. And here we have a chart of the daily chart of the Nasdaq. If we zoom in, we will see what today's price action has done. It has broken all the moving averages the market needed to break, and it has given us a close above the range that we've been in. Certainly we think there's very little impediment to the market trading 68.50 next week, and after a few days of consolidation it should go and trade towards the 7,000 and fill all the gaps, especially in the Qs, which we will now have a look at. This is a 300-minute chart of the Qs, and the first gap is here at 166.35. We expect this to be filled on Monday. A couple of days of hesitation, backing and filling. We really don't expect the market to go below this moving average. 163 should contain it, and then this is the target up here, 170.80. That will be a very nice move, indicating that the futures NQ will be around 7,000. That certainly is a very nice move and very well worth having. We've had the leadership change back to tech, and that is an excellent signal. The bearish sectors within the S&P, like the XLF, have really not done that well today. Yes, they've come back towards the middle of the Bollinger Bands, but they still have a lot of work to do, and XLF is certainly not going to be a leader for quite some time. That is why we much prefer the technology sector than we do something like ES, which has so much of an XLF component, about 25%. XLF is really going to struggle around these levels, around 27.77. It is really going to be very hard for XLF to go much more than another percentage point, which would take ES only around the 2700 level at best. The other bearish sector, XLI, again because of the dollar, all it's done is come back to the middle. This is not a bullish picture. It'll go up and down in this range for a while. It might go up to 73.70, but that is not a very bullish picture. Again, indicating that probably the best ES is going to do is around the 27.05 area. And here we have a daily chart of the SPX. If we enlarge it, we can see what is going on. It's certainly been a bullish day. We are very happy with it. It's bounced off the 200-day moving average very decisively. It's turned some of these, and really this is it. 27.05, 27.07. That's about as far as it can go. You can see how less bullish than NQ, XLK, and the Qs this chart looks, rather than those. We are not buying the ES. We think it has another 30 to 40 points higher, which is a percent and a half, while we think the XLK probably has at least double that. And finally, this is XLK. You can see the positively sloping averages. You can see how it's breaking through the top of the Bollingers and will have at least 3 drives higher, and this would be our immediate objective around 69.60 sometime next week. That is a good 2 percentage points and higher, and we think that should certainly be attainable at some stage next week. This is a chart of XLK over XLF, so technology over the financials. Our view is not without risk. You can see how many times we have bounced off this area. But we do think that time has come for this to actually start breaking higher and retest the all-time highs. To us, there is going to be no rally in equities which is not led by XLK. That is the most important sector by far in the States and will continue to be the most important sector. As you know, we buy XLK against other things on every dip, and we shall continue to do so. Certainly this chart indicates to us that we have a very well defined stop. Anything now below this moving average around 234 is going to be our stop. We think it continues and tests these highs, which we'll now mark in so you can have a look at them in the weeks to follow. Oops, not there, but here. Oh, hard one. It won't stay. Here we go, 258. That is the level that we think it's going to go to in the next few days or weeks. This is XLK over XLI, and you can see this is a very long-term chart going all the way back to 2005, 2006. We have a move now which is breaking higher. The industrials are being left in the dust and technology is the leader. Therefore, if you're going to be long, always be long the leader. The leader is technology. It's going higher. It's probably going to go at least a couple of percentage points more than the other sectors. If we have a look at our fundamental friend, the forward earnings evaluations, we can see now that we are very well contained by the 16 times Blue Angel. Since the market cannot break below times 16, it'll most probably go and test times 17 at some stage, and that is very close up to 2800. This is naturally weeks away when it's not a short-term story, but we can see that since it just cannot break below the 2600 level, we are more likely to go up than down. And if we have a look at the sectors, we can just see how not expensive we are, especially in things like consumer staples. Financials are not hugely expensive. They can come down some more or trade sideways, but nobody can say that they are hugely expensive. Industrials to us are still expensive, can easily come down to times 14, but never mind. But one can not say that they are ridiculously priced. And finally, our favorite, really, technology is really not expensive at all. Going up towards 20 times for technology will take it up another 7-8%, and that is eminently doable. So nothing that we have technically shown you is at all countered by fundamental analysis either. The only thing we haven't covered is really the European fixed income. That's because there is absolutely nothing to cover. The ECB has basically killed it stone dead. The market will probably now come back down towards -17. which is another 50 points higher in the bubble. This is a 5-year chart, so therefore the bubble. But you can see by these Bollinger Bands that at some stage it'll bounce back up again towards positive territory. If it does that before it stopped everybody out, God knows. But certainly -17 to -20 is the area that we will be looking for to reinstate short positions in the futures. And so on to our biases for next week. As we said, 5 and 10 years, looking to range trade. We are looking for a range trade for the next several weeks, and then to follow the break, which we think at some stage will be higher, but not for the foreseeable future. Bund and Bobble, we are changing this to -17 area, simply because it's so boring. That is the level one really has to have a short position and just leave it. That is what we will be doing. We know that it's going to go to 2%, and we know that it's not going to take that long into next year, when the market just breezes through the ECB levels, and that's that. Looking for a break higher. Yes, we are still looking for break higher. 27.05 is the level that we will be looking for into next week, simply because the dollar won't allow it to do much better. NQ definitely should perform on the upside, test near all-time highs or very close to it, and it has resumed leadership. Therefore it's worth being long NQ as opposed to anything else. VIX has been the one that's been telling us all week not to be short of SPX, and it's quite right. VIX probably has another 2% to go down before it's a buy. 13.5 is the level we showed you several weeks ago on the video, and that is the one we still want. Everything else has worked well. Here we are, we breezed past 12,650, probably 13,000 coming up very shortly. That is where one probably should start to fight it, or rather move money into out of European stocks and into US stocks, especially the Nasdaq, but also some XBX when you sell the DAX. Everything else is still there. This 92, 93, probably 94 as we showed you, that will be the level that we probably can say is the top for the dollar, and from a headwind it'll start becoming a tailwind for US stocks, but it's going to take quite a bit of time. Thank you very much indeed. Have a lovely weekend, and tweet you on Monday.